Welcome everyone. In this webinar on common mistakes in options trading, myself Amar Singh. The structure of the webinar is going to be that I will be first talking about the key terminologies in options. What are the key terminologies that you should be aware? The second is why options. How options can really help you enhance your trading skills and also help you spot opportunities in the options market. What are the do's and don'ts? Then we'll be covering practical insights into the option trade as to what are the factors that you should be looking into while entering into an option trade. And lastly, I'll be talking about what are the common mistakes in options trading. What are the most common mistakes which majority of the people who are trading options commit, and how you can stay away from them, how you can step aside and how you can be different from them and avoid the common mistakes because these mistakes are common and at the same time they are very costly. So what we will do right now is that we will talk about options, the key terminologies, and we'll then get into the other aspects. So I'll spend some time on the key terminologies as to what are options and what are the different types of options and how you can trade these options. And also I'll explain with practical examples which will be of great help to you. So basically options you need to understand is that options are very good derivative instruments, leverage instruments to trade both the long side and the short side of the market. So if you're bullish on the market, you can buy a call option. If you're bearish on the market, you can buy a put option. And the best part is that if you're a buyer of option, there is no obligation on you. So you can, if it expires worthless, you don't have to worry. And if you're making money in the option, you can square off your position. You can book your profit as well. So, but if you're a writer of option, then there can be obligation for you. So I'll be talking about the different aspects of options. On the right hand side, you see that I have put in the Nifty 50 chart here. So this I've taken from the NSE India website. What you see is that this is a 10,400 call option with a expiry of 25th January 2018, and the option was at 163.05, and you can see for yourself that there is the movement is significant. If you see the high of the day and the low of the day, the high was almost 200 and the low was almost 150. So we see a significant movement or percentage change in options on a daily basis. So options are a good instrument to trade, and be it short term, I would say primarily short term to medium term, because it's not for investing, it's primarily for your hedging or for trading is what you use your options for. So coming to some of the key terms, I'll not be speaking extensively on options, but I'll be just touching about the few key terms which are there. You have something called in the money, at the money, and out of money options. So you have again the call option and the put option. So when we're talking about call option, the market price of the underlying asset is more than the strike price. So generally you find that all the strikes which are below the market price, they are in the money. If the strike price and the market price is the same, that's at the money. And if the strike prices are above, this is I'm talking about the call option. If the strike prices are above the current market price, then that's out of money. Simply the reverse, what you need to remember is that the reverse is applicable for the put option. So so in the put option, what happens is that in the money you have all these uh, the market price of the underlying asset is less than the strike price. So you have all these options which are above. I will give an example also. We'll talk about with an example so that we even clear. So we'll move to that as well. But before that, I just want to cover a few other key terminologies. That's Greeks. So here there are many Greeks which are there in options. You've got delta, theta, gamma, vega. What you definitely need to understand is the first two, that is delta and theta. Generally, we don't look at these, but this can really help you. What you need to understand is it's very simple to understand. I'll give you with an example that delta basically refers to the move the option registers in comparison to its underlying value. Means its value can change from value can range from 0 to 1, and so very deep, you have deep in the money options, you have at the money options, you have out of money options. Calls have positive delta, whereas puts have negative delta. So we'll just take an example. That if a stock option has a delta value of 0.65, this means that if the underlying stock price increases in underlying stock increases in price by rupees 1 per share, the option on it shall rise by 0.65 rupees per share, all else being equal. So what you need to understand is that if you see the delta of an option, if the delta is greater than 0.5, 0.6, that means if the underlying moves by 1 point, your option will move by point 0.5. So if the premium was 50, so it should ideally become 50.5, 50.6. But that again, you need to understand that this is one. If in case there is increased volatility, then you would find that the options are highly priced, and there you might not find that the delta is moving exactly. So there are other things also, but what you need to understand is delta is something which is very important. Then the second is theta. Theta measures an option's rate of decay over time. When we study theta, we must have a clear understanding of time and value. What it means is that if you're buying an option and if you're holding that option for a day or few days and for few weeks, so if you're holding it for few days and few weeks, you will find that even if the underlying, that is a stock, say for example, you have a buy option in Infosys, and Infosys says trading around 1,000, and you have a strike of say 1,000 only. 1,000 call option you have bought, say, and the premium is 100 rupees, just to give an example. So what it effectively means is that if Infosys, the stock which is trading at 1,000 is not moving anywhere, it's just remaining at 1,000 for a few days. So your option premium, which was 100, will not remain 100, it will decline in value. So because every passing day, the theta eats away the premium of your option. So you need to understand that when you are trading options, when you're buying options, you should ideally not hold your options for more than a few days. Means generally, if you're holding it for a few weeks, or if you're holding till expiry, and then towards the expiry the market moves in your favor or the stock moves in your favor, yet you find that you don't make money, is because of theta. Because the theta is the rate of time decay, and this really eats into your option price. So this is something which you need to understand. Very simple, not much complex here. And delta, as I said, you get to see what is the delta of the particular option. Then apart from that, we've got other terminologies like gamma and vega. So I won't be covering them. We have got our other webinars there where we talk in detail about this. But what you need to understand here is that delta and theta, these are something which you definitely need to know. Apart from that, what is in the money, what is at the money, what is out of money, and where can you see this? And I'll also explain with examples. So then the next question comes is why trade options? One is that options is an effective hedge. So if you have an existing position in the cash segment, you can buy puts if you feel that the market is likely to correct. So you can use it as an insurance cover. Then attractive returns, because here what happens is in options is that you are trading a leverage. Just to give an example, say for example, Nifty is trading at 10,500, and you buy a 10,500 call option, say at a premium of 100 points. So you need to understand that each and every option of futures has a lot size. So for Nifty, the lot size is 75. So if you multiply the premium, that is 100 into 75, so the 7,500 is the margin that you pay. Now if this premium of 100 becomes 140, so ideally you're making 40 points into 75, 3,000 rupees. So you're making 3,000 on an investment of 7,500. So in terms of percentage, the returns are phenomenal if you're trading options, but provided you're trading options well. That can only happen when you take care of, as I just said, about two, three things. One is that don't hold your options for as long as you hold your equities. That's not a good idea. That's a very bad idea, because the option premium will eat away, the theta will eat away, the time decay will eat away the option premium. And secondly, don't get into or don't buy deep out of money options. Means I'll talk about that as well. But the best part is that options can provide you with attractive returns because you can trade with a small amount of capital. Then the limited risk is there because your risk is limited to the option premium that you have paid in case you're an option buyer. But in case if you're an option seller, then you can have an unlimited loss as well. You have lower risk and high volatility. The volatility in options market is quite high at times, making possible handsome returns. So you'll find that you've got options of Bank Nifty weekly as well as Bank Nifty monthly. So if you look at the Bank Nifty weekly options, you'll find that there the volatility is even high. So the probability, the possibility of making handsome returns is also there, but at the same time, if one doesn't trade well or doesn't know how to trade well, then one can take a hit also. So one needs to understand from that perspective as well. Then operational in all markets, you can trade options in all markets, be it a bullish market, be it a bearish market. So if you're bullish, you can buy a call option. If you're bearish, you can buy a put option, as well as if the range bound markets, then also you can sell options and you can make some money. So now I'll just give you some practical insights into which options to trade successfully. And this chart I have taken from NSE India website, NSE website. So I will explain to you what this is. It will really help you understand. First of all, what is there on the left side, I'll talk about that. That you need to stay away from deep in the money options. Deep in the money options, if you look at this particular chart which is there, I have taken this of Nifty. So if you look at the strike prices are from 10,050 and below we have 11,500. So that's the last column if you see. And now you look at the column which is the LTP, last traded price. If you look at the red column which is the net change column, just left to it you have this LTP, that is the last traded price. Now if you look at the option which is there, option price which is there for this 10,050 strike. So there we have not seen any action there. Now we take the 10,100 option. There we are seeing that the LTP is 387, and here we've seen some open interest also and volume also. You can see that the last left column is OI, that is open interest, then change in open interest, then volume, then there's something called IB, implied volatility. And so what it effectively means is if the volatility is less, the option pricing is generally option price is low. If the volatility is high, the option premiums are higher because there more volatility is expected. So you can look at this. And so what you can see is that for the 10,100 call option, you have to pay a premium of 387. For a 10,150, you have to pay a premium of 340. For a 10,200, you have to pay a premium of 300. So as you are seeing, so this 10,100, 10,150, these are deep in the money options. So you have to pay a significant premium. So if you multiply 387, if you can take it roughly as 400. So if you multiply 400 into 75, so because the lot size of Nifty is 75, so what you see is that 30,000 is what you have to pay to buy one option which is deep in the money. So you don't need to get into deep in the money. But if you're looking at say a 10,400 option, it is at 163. If you look at a 10,450 option, it is at 10,450 is at 134. If I look at a 10,500, it is at 106. So you can see for yourself that, say for example, there are two people, one who's buying a 10,100 call option and the other who's buying a 10,500 call option. So someone who's buying a 10,500 call option is paying roughly 100 rupees, 100 as premium. So 100 into 75 is 7,500. And the other one who's buying a 10,100 is paying almost 30,000 as premium. So ideally, there is no big advantage if you're trading deep in the money options. So I'll talk about which options you should buy. So as you can see that as I move lower in this table, the option premium which I start paying is less. So then below the 10,500 at 10,550, and then below last one on the bottom is 11,500. So if you look at 11,500, what is the LTP is 0.7. So effectively it means is 0.7 into 75. So roughly 50 rupees. So by paying 50 rupees, you can buy a Nifty this 11,500 call option. Now the question is that you are right now Nifty is at, say for example, 10,500. So you're buying a 11,500. Why do you need to buy? There are people who are buying it, but I would not suggest, because just because the premium is very low and it's very cheap, so you should buy. So this is something which you should stay away from, because there's nothing called cheap. Everything is relative. Everything has a price. So you need to understand that. So that's what is the second point. Stay away from deep out of money. So first is stay away from deep in the money options, and then stay away from deep out of money options, because out of money options, say for example, if you are buying a 10,800 also, so 10,800 call option, you pay roughly around 10 rupees, 10 points. So 10 into 75 is 750 is the premium that you have paid. So you bought an option, but that's not a good idea until unless you are buying it and you are very bullish on the market, that the market is likely to move by 300, 400, 500 points, and you want to hold it till end of expiry, or in Nifty in particular and Bank Nifty, you can buy multi-month contracts also in options, because they are quite liquid. So that advantage is there as compared to stock options. Because if you look at the futures and options segment closely, we've got close to 216 stocks which are in FNO segment. But in the options, roughly 80 to 90 stocks are there which are active in the options segment, and out of that, if you see which are most liquid, roughly 20, 25 would be the ones which are most liquid. And Nifty, Bank Nifty, anyways, they are the most liquid, so you can trade them anytime as long as you want. But what I want to say is that don't just buy an option and trade it like a cash segment, like a stock, because the time value, the time decay is going to eat into your option premium if you don't have the timing right. So, where we had taken the examples of calls, here this chart is the example of puts. So I don't need to get into this into detail, but it's the same thing. Here, what we see is that all the options, if we look at the options which are there, here it is completely different. That in this case, all the strikes above which are above the market price, they are in the money. So you'll find that the premium is significantly high. So in that case, what we are seeing for the 11,000, if you just take the previous example, for the 11,500 call option, the premium was 0.7. But for here, the 11,500 put option, the premium is 1,024. So this is deep in the money. So what you need to understand, as I said, is that it's the at the money, in the money, out of money. That's something which you need to understand. Then the next is that what is delta, and the next is what is theta. And so as I said, that avoid deep in the money or avoid deep out of money. So what you need to trade is trade slightly out of money, at the money, or slightly in the money. Generally, what does slightly mean is that if, say for example, Nifty is at 10,500, so you have options on at above. If I take the strike, so it will be 10,500 is, so it could be 10,550, 10,600, 10,650. On the downside, it will be 10,450, 10,400, 10,350. So ideally, two or three strikes above or below the current market price. So you have to look at the current market price of Nifty and then take two or three stocks. So two or three strikes which are above and which are below. What you will find is that in majority of the cases, those will be the strikes which will have the maximum volume as well as open interest. So what it effectively means is that when an option has the highest volume and open interest in a particular strike, you will find that you will get the best bid and ask spreads also. So here, if you look at the bid and ask spread for the 11,450 put option, you'll find the bid is 901 and the ask is 1059. Here it's not at all traded. Not much, no trading has happened. But if you take the above 11,400 strike put option, so here the bid is 919 and the ask is 936 roughly. So you have a significant difference. So, but if you say, for example, look at a 10,500 put option, So here the bid is 145 roughly and the ask is 146. So it's only a difference of 1. So the smaller the difference between the bid and ask, the better off you are. And this is something which you should definitely pay attention to, and it is all the more relevant if you're trading stock options. Because in stock options, the bids could be the difference between the bid and the ask could be significant, and that could really eat away any profit that you're making. So you need to be careful of that. So avoid options, one, which are illiquid. And how do you determine which is whether it is liquid or not? You just look at the bid and ask spread. If the bid and ask spread is greater, you should avoid it, and then you should also look at the volume and the open interest for that particular option. So what you should ideally trade is you should trade slightly out of money, at the money, or in the money. So then there is a time for all seasons. So there are various option strategies are there which you can learn. We'll be having webinars on that as well extensively on various option strategies. So that's something that you all can definitely participate in. It will help you understand whether you need to trade a straddle or a strangle, or for that matter it could be a bull spread or a bear spread. So that will definitely be covered. Now we look at some of the common mistakes in options trading. And here what is that it's not only options trading, any form of trading that you have, you need to follow this. And generally the first and most important is the lack of a trading plan. Meaning what is that what a lack of a trading plan here it means is that you are entering into a trade, you are entering into an option trade without having a clear idea as to where you will exit if you're going wrong, and where you will exit if you're going right. It's just like there is a train which is standing, you get into the train without knowing what your destination is, and where you have to get down. So that's not a good idea. So, and we don't do that things in life. So why do we need to do that in markets? So the first step begins with developing a well thought out trading plan. And also what's important is emotional attachment to money is deadly. Generally, if you take a trade and just think about the money that you will make or the money that you will lose, then you're trading emotionally, and that can really be something of a negative for you, and it could be really not good. Also, thinking of it as money is not the worst thing. The worst thing is when a trader looks at his at the money in his trading account and thinks of all the things that he could buy with that money. So generally, when you're making a lot of money or when you're making good profits, you say, okay, I'll buy this, I'll buy this, I'll buy this, or I'll if you're losing money, oh now I can't buy this now. That's not a good idea. What you really need to think is that whether I'm trading right, whether I'm trading wrong first. Secondly, do I have a trading plan? Do I know where to enter? Do I know where to exit? Do I know how many lots to buy, how many lots to sell? Can I protect myself against the losses? These are the questions which you keep on continuously asking yourself. Then you stand a far superior chance of being successful in the options market. And believe me, options and futures, they are the biggest stakes games in the world. So here there's a lot can be made and a lot can be lost as well if one really doesn't know how to do it right. And apart from that, what we see is that one of the most difficult things for option traders is to ride a winning trade. When you get into a trade that generally moves in your direction, the desire to make money and run can be overwhelming. It can also be a huge mistake. So, for example, you buy an option of say Bank Nifty 10,500, you paid a premium of 100. So effectively 7,500 is the cost that you have taken. And yeah, one more thing I would like to add here is that just to have bought an option say for 100, and so your investment is 7,500 for a nifty call option. You don't need to assume that you are losing that entire 7,500. So if the market is not going in your favor, or if the strategy or if the way you have entered the market, you are not very confident of that, or maybe you want to change your view, then you should get out of the market, and whatever money you can salvage, whatever money you can save is something which you can use for your next trade. So it's not that you have put in a trade of option 7,500. So now either I will make it zero or I will see. So that's not a good idea, because it will become zero if it is not going anywhere for a few days. So that's something which you definitely need to pay attention to. Then there's something called taking too much leverage. Generally, as it is, options are highly leveraged instruments, and you can take leverage, but generally what happens is that you should take leverage only if you understand options and if you can protect yourself, because leverage is a double-edged sword. You can few people become very rich, and upon which the majority of options traders fall. So what you need to understand is that leverage can help you, but leverage can hurt you at the same time. So how do you protect yourself? If you're trading leverage, high leverage during intraday, then never carry such a huge position overnight. And if you are making a profit, then also you should exit a trade. If you're in loss, then also you should exit your trade, because up gap, down gap, when the market next day happens, it could either be in your favor, it could be against you. So those are certain situations which you should protect yourself. So if you're holding on to positions, then you should definitely make a point of having low leverage. If you are only trading intraday, then you can take a fair amount of leverage, but then also you should know what is your threshold limit, what is the limit that you really want to take leverage, and you should be comfortable. That's something which is very important, because if you are taking a trade and then you're getting stressed out, then that's not a good idea. But generally, it happens to each one of us that when we are taking a trade and the trade doesn't go against us, there is a fair amount of stress that builds into our system, and then we start taking all the wrong decisions. So what it effectively means is that if we have some system, some strategy, some method, some technique of trading, and then seeing whether the trade is moving in our favor or moving against us, so that can go a long way in helping us maintain our stress and also maintain our calm. Because trading is, if you compare trading, it's more or less like a battle, it's war. So you have to be very cautious, very careful, at the same time fully and thoroughly prepared with any eventuality that can happen in trading as well as in war. So it's not the probability of the markets that cause the majority of the problem. What causes the majority of the problems is the amount of leverage. So as I said, just to give you an example, I was talking about Nifty. Nifty. So the option is premium you pay 100 points. So 100 into 75 is 7,500 is the premium that you pay. But if you look at the lot size of Nifty, say for example Nifty is at 10,000 and the lot size 75. So it's a 7,50,000 contract, and you are just spending 7,500 to build a position which is equivalent to 7 lakh. So it's a 1:100. So with 7,500 you're building a position worth 7,50,000. So if you want to trade more and take more leverage, you need to understand the pros and cons. So that's something which is very important. And the most important point here, what I would want to add here is that ideally, if you're trading, you should not risk more than 2-3% of your capital on any particular trade. What it effectively means is that if you're having a 1 lakh or a 1 lakh account, so ideally you should not risk more than 2-3,000 on a particular trade. But if you are betting all your money on that one particular trade and that trade goes in your favor, then you come out a winner. If the true trade goes against you, you lose all your money in one particular trade. That's not a good idea. That's a very bad idea. So ideally what you should see is that if you are having, so if you, what it effectively means is that if you are risking 2 to 3% on a particular trade, that means if 33 trades go continuously, subsequently they go wrong, then you are out of the game, which is not likely to happen. So it effectively means that you will be in this game for a long period of time, one. Secondly, what you need to understand is that learning from the mistakes, learning from your trades is also something which is very important. If you don't do that and keep on repeating the same mistake again and again, then how do you expect different outcomes? The outcome is going to be the same. So we'll look at the other mistake which is very common in options trading is failure to control risk. Basically, generally what happens is that if you start losing a battle in the options market, your best bet is usually to turn tail and run the cover. Unfortunately, because this kind of thinking runs counter to the way most of us have been taught, many traders focus on fighting the good fight rather than cutting losses. So what it effectively means here is that if you are in a losing trade, as I said earlier, you don't have to lose the entire amount. Whatever you can salvage, you should get out. But you have to, if you are entering a trade, there has to be some reason. If you are exiting a trade, there has to be some reason. You can't just get out of a trade because you're making loss. That's not again a good idea. Then you'll find that most of your trades are ending in losses. So if you have some strategy of entering into a trade, some strategy of exiting out of a trade, whether it be a profitable trade or a loss-making trade, then you will be in a far better, I would say, mental state also, and your risk control will also be significantly better placed to help you tide over the different conditions which are there in the markets. So your very first priority as a trader is to always do whatever you have to do in order to trade again tomorrow. So the point here is that don't risk too much on a particular trade. ideally 2% to 3%. Some people take a risk of even 5%, but ideally should not go above that, because if you are risking 10% on a particular trade, then you are risking significant. That means 10 wrong trades and you're out of the game. So and the market is neither for you now, neither the market is against you. This is what you need to understand. So this is an important point here. Apart from that, the ultimate goal in options trading is to make money. The more the better. How the trade-off that needs to be considered is the relationship between total profitability and volatility of performance. So what it effectively means here is that if you are trading options or if you're trading any segment, one day your account is showing a balance of 20%. The next day your account is showing a balance negative of 20 or 30%. The next day it's again up by 10%. So that's not a good thing. That means you are basically trading emotional. So if you want to check for yourself whether you're trading emotionally, or whether you're trading with a rational or region or a rational or logic, you can simply write down your equity curve. Means what is the balance in your account at the end of the day. So if you can write it every day, within a month you will know exactly whether you're trading emotionally or whether you're trading with some logic. Because if the equity curve is fluctuating too much, that means you're trading emotionally. If it is not fluctuating too much, that means you have some reason, some logic, and some emotional control which is actually helping you. So no matter how profitable you have a trading strategy, if there's too much of stress that is coming onto you, you should look at revamping or changing the style of the way you've been trading. So that's something you should definitely look at. Then apart from that, something which we all should look at and definitely try to improve upon is discipline. Because a lack of discipline is defined as failing to do what you should do in a given circumstance. A lack of discipline in options trading is always a mistake. I would say in any form of trading is always a mistake. So what it effectively means is that when you are supposed to pull the trigger, then you have to pull it. Means if you have taken an option trade on some logic, and if the market is moving against you, and if your stop loss gets triggered, then you have to get out of the market. One important point here you need to remember is that when you're trading options, you can have the stop loss as per the underlying. So underlying in the cash segment or in the future segment. Cash segment is also fine, because having a stop loss based on the option is not a good idea, because as I said earlier, that option has the unique characteristic of having something called theta or time decay. So if the stock is not going anywhere, or the Nifty is not going anywhere, still you'll find that your option premium is declining. So having a stop based on an option price is not a good idea. Ideally a stop, even if you're trading options, should be based on the underlying. That's something which you need to understand. So discipline is most essential to pull the trigger or not to pull the trigger, as the case may be. Becoming bent on getting even is a perfectly natural response to any setback. Unfortunately, it is also a surefire way to fail as an options trader. Generally what happens is that this is getting even here in means is taking revenge. That if you take few trades and the trades don't go in your favor, or they go against you, then you get angry, you get annoyed, and you feel that no, now I will not leave the market, now I will do whatever is required, I will get back. That's not a good thought. And as I said, that emotional trading or emotions anyways, and now the emotions which I'm talking about was more of anger. So be it anger, be it greed, be it hope, be it fear, these are not good for when you're trading the markets, because they basically set up for you to fail, because then in that case you'll be majorly taking all wrong decisions. So what separates those who make money in the long run from the 90% is that financial and emotional capabilities to survive a breach in discipline. So emotional capability, somewhere or the other, we also have to look at the emotional strength, where we are on the emotional side, where we are on the financial side, and willingness to learn from mistakes and to never repeat a mistake already made. We all make mistakes, and there's no harm in making mistakes. There's nothing wrong in making mistakes, but repeating the same mistake again and again is not definitely not the right way of trading in the markets. But that can only happen if you measure what you're doing, because what you measure can only improve. What you don't measure will never improve. So and also what you need to understand, one more thing, is that there's nothing called right or wrong. So that your trades are going wrong, or trades, what if you can learn anything from it, that's a good learning for you. So now we look at the four cornerstones of successful trading, which is for any market. Go with the trends. That means you go with the flow of the market. You don't go against the trend. So if the bulls are strong, you go with the bulls. If the bears are strong, you go with the bears. How do you find who's strong? Most of the time you can use technical analysis charts. We have our Angel Advanced Charting application also, which if you all are using, very good. If you're not using, you can definitely subscribe to it. You can write at ebroking@angelbroking.com and mention your client code, so you get activated for this particular chart in Speed Pro. It's primarily right now in Speed Pro, and then you can plot your futures chart, options chart as well. So the first is go with the trend. Then the second is cut your losses. So you need to cut your losses. If you are in a losing trade, you don't have to lose your entire money. Whatever you can save, you should save. Then let your profits run. This is the tough part. This is the toughest thing. That means if you are in a profitable trade, generally what happens is that we like to book our profits fast, because there's something called paper profits, something called notional profits, something called actual profits, something called the or book profits. So for example, you bought the Nifty option at 100 and it goes to 120. So you booking profit of 20 into 75. So 1500 is the amount of money that you made on a 7,500 investment. So in terms of return, that's a 20% return in a single day, just to give you an example. But say for example, you are bullish on the market and Nifty is also likely to go up. So maybe the option from 120 it could go up to 180, 200 also. So in that case you can hold, but you need to, before taking a trade, you should be clear whether this is a positional trade or this is a short-term trade, or what. Because generally what happens is that when most of the people, when they are in profit, they become a trader, and when they are in loss, they become an investor. So if you are in a profitable trade, you will book your profit and you will get out. But if you are in losing trade, you will hold on to your trade, hoping that one day the market will turn in your favor. And the last is, don't let the big winners get away. It's just like the game of cricket. If you are the batsman and six balls are being bowled to you in an over, and so you find that four are dot balls. So you play them accordingly. You give them some respect, but you find that there's one loose ball, so you hit it out of the stadium, so it goes for a six. So the point here is the same, that if there would be some trades where you could make a lot of money. So ideally, not letting those big winners get away is something which most of the successful traders do, because they also have losing trades. So they know that they'll have losing trades, because if you're trading, you'll have losing trades, you'll have winning trades. But net, what you need to remember is two things. You should not make a significant or a major loss which can really impact you financially, psychologically, or emotionally. And secondly, few trades which are going definitely strongly in your favor, you should try to hold them as much as possible, so that you can use a trailing stop loss. And so there's one truest maxim. Maxim is nothing but a quote in trading, that if you absolutely positively cannot afford to lose any more money, you absolutely positively will lose more money. So the point here is something which is of great significance, that if you are trading with the mindset that I don't want loss, I don't want loss, I don't want loss, then most likely you'll make loss. But if you're trading with the mindset that I will trade right, I will trade right, I will trade right, and what is required where I will do, then you are trading from a different, I would say, frame of mind altogether, and so you'll find that the results are also different. Because in this earlier case, I will not take a risk, I will not take a loss, I will not take a loss. It means that one is trading from the fear factor. So trading from an emotion which is fear, one cannot expect a positive result. So as I talked earlier about our Angel Advanced Charting tool, you can use this. This is primarily for those who are using Speed Pro. You can write to ebroking@angelbroking.com, mentioning your client code and request for activation of Angel Advanced Charts. Those who are using mobile applications, we have our all stock calls which are there in the stock idea section, so you can look at them. Apart from that, you can always attend our webinars. We have many webinars which are coming up this month on advanced options, as well as on technicals as well. So you are free to uh, attend them. And also, apart from the webinar, if you have any questions, we can take the questions now. But you can also write to us, and we definitely revert back on the same. We can take questions now.